Hello, this is Japanese Economic Review Channel. Today, we will discuss the Bank of Japan's Corporate Goods Price Index, released on April 10, 2026. We will analyze the March 2026 flash report and the FY 2025 summary. Our focus is how energy markets and currency dynamics are driving structural inflation in Japan. Let's explore what this means for your business. In March, the domestic CGPI reached 129.5, up 2.6% year-on-year and 0.8% month-on-month. Export prices surged 13.3% year-on-year in yen terms, while import prices rose 7.9%. These figures indicate a broad-based price expansion. We are seeing a swift return of import price pressures, driven by global commodities and magnified by a weaker yen. Looking at the trajectory since 2018, all major corporate price indices have broken out of historical channels. Notice the massive spread between import and domestic prices. Since the 2020 baseline, the yen's depreciation has created a significant gap between contract currency and yen-based prices, creating sustained upward pressure. What drove the 0.8% domestic monthly increase in March? It was highly concentrated. Over 73% of this growth is attributable to just two sectors: petroleum and coal products, plus 0.46%, and chemicals, plus 0.13%. Gasoline, diesel, and basic chemicals are dictating domestic inflation, highlighting our deep vulnerability to energy shocks. The currency wedge is a critical factor. In March, the yen depreciated by 2.3% MOM, reaching 158 United States dollars and 70 cents per JPY. This acted as a multiplier. For imports, a moderate 1.5% contract basis increase translated into a massive 3.3% spike in yen terms. The weak yen continues to artificially inflate costs, turning minor global bumps into heavy localized shocks. Global energy markets command our import baseline. Out of the 1.5% MOM import contract increase, petroleum, coal, and natural gas contributed a staggering 1.34%. Crude oil and jet fuel were primary drivers. Excluding this volatile sector, organic import prices would have remained virtually flat in March. This underscores energy's oversized impact. Shifting to the fiscal year 2025 summary, the narrative changes slightly. The domestic FY 25 average grew modestly by 2.7%, while the import average actually fell by 3.3% year-on-year. However, while FY 25 saw aggregated softening in import costs, the latest March data warns of sudden inflationary spikes returning to the market. The overall 2.7% domestic FY 25 growth masks violent sector rotation. We saw extreme asymmetry. Agriculture, forestry, and fisheries surged 31.5%, and non-ferrous metals grew 13.7%. Conversely, iron and steel contracted by 6.3%, and chemicals by 3.2%. Corporate pain and pricing power are highly uneven across industries. The BOJ data captures a vital inflection point. While FY 25 averaged a 3.3% decline in import prices, March 2026 exhibits a violent slingshot back to a 7.9% increase. Export momentum also saw a massive acceleration to plus 13.3% year-on-year. This sharp trend reversal signals that deflationary pressures have abruptly ended. Taking a 45-year perspective, we can definitively declare the end of the deflationary era. After 40 years of drifting sideways or downwards, the index surged 27.5 points in just 5 years, reaching 127.5 in FY 25. Current CGPI levels represent a fundamental structural break from Japanese corporate pricing history. To conclude, there are 3 strategic implications. First, energy vulnerability. Our baseline remains hypersensitive to global energy. Second, the currency multiplier. Yen volatility dictates localized price shocks. Finally, the end of price stability. Corporations must adapt to an era of dynamic pass-throughs and structural inflation. Thank you for watching the Japanese Economic Review. We look forward to having you with us again.